Hey there, this is Andy with the Baking Group, and we take some calls on Tuesdays, and a call came in today from an investor who had a bit of a snafu. So I wanted to cover what the snafu was about and how to get around that snafu so it doesn't happen to you again. Okay, so it was about buying a rental property and then trying to refinance it. So first off, I wanted to talk about two ways to buy rental property so you understand where the problem occurred in the first place. So we have a scenario here. These are not the investor's numbers. This is an example to make it easy so we can kind of do some of it in our heads. So there's a purchase price of 100,000, a repair cost of 10, and we think the property will then be worth 140 after repaired value. The rents are 1,000. If I got a new loan for the purchase price, when you go to a bank, they will loan you money based on the purchase price only, usually, okay? So it's for an investor, it's 75%. For a homeowner, it's anywhere from say 97, 93% to 80%. It's all over the map, depending on your FICO score, who you are, things like that. Okay. Anyway, so in this particular scenario, we require a 25% down payment and a $10,000 in repair cost. So I'm going to show you what this looks like on the calculator real quick. Okay, where was it? Sorry about that. I think they're having an air show today. I had to get up and close close the sliding glass door to the patio. Anyway, okay, so here's the calculator. Let's see what this thing looks like. Let's scoot it over a bit. Okay. So the purchase price was $100,000. The bank will give us 75%. So there's a new loan at $75,000 with the new principal, interest, taxes, insurance payment of $593 roughly. Okay. We come over here, the rents we said were 1,000. Out of pocket cash is 35. That is the 10,000 for my repair and the 25,000 for the down payment. That's where they came from. For an ROI of roughly 14%. That's a traditional rental, how some people will do that, okay? So let's go back to the other one here on what most of us do. Okay, which is what this investor was attempting to do also. So this time the ARV becomes very important because we're going to refinance the property after we purchase it based on a new appraisal. In other words, the new as-is value, okay? So again, they're going to go 75% of whatever that's going to be. So we're going to call it 105,000 for a new loan. The purchase price was 100, repair cost was 10, rents, but this time our ROI doubles. And I'll show you what that looks like on a calculator. And I'm just blasting through this because this is not the purpose of the video. The purpose of the video is to explain where the problem occurred and why. All right, so here's our new loan for 105. Understand, we paid 100,000 for the property, but we borrowed money. Paid 100,000 for the property, we put 10 into it. So we're into the deal for 110,000. 75% of 110, I'm sorry, 75% of 140 is 105. So we're $5,000 out of pocket for a second, okay? 105 for the new loan. There's the new payment. There was the rents. Out of pocket is 10,000, even though I just said 5. I'll explain in just a moment. For a new ROI of 28%. I said earlier, a lot of us borrow money to do these deals because when we borrow money, it places a lien against the property from the lender. So it costs money to borrow. So if I borrowed 110, 100 for the purchase, 10 for the repair, hard money lender might charge me 3 points, 12%, something like that. For 6 months, that's 10 grand. Well, I know that for me to buy a property, fix it up, 10,000 worth, and put my renters in, I'm probably in and out of that thing in about 3 months. So I took half of that 6-month period, 5,000. So I took 5,000 from there, and the 5,000 I'm out of pocket on the difference up here, and that's where I came up with the 10,000. Okay, but that's what that looks like. I just want to explain the two rentals and why this particular investor was attempting to do this in the first place, because it's, in my opinion, the way to go. Okay, so the call came in. Okay, so the call came in and said, "Hey, Andy, the bank won't refi my property for 12 months." I said, "Oh, you must have paid cash." And the investor says, "No, I didn't pay cash. Actually, I got a hard money loan." At which point I said, this doesn't make much sense. Go to another bank. Because the banks are pretty good about refinancing anything but cash purchases. And the investor says, well, they won't do this even though it's a hard money loan. I said, it still doesn't make sense because there should have been a lien against the property. The banks are looking for liens to refinance the lien. In other words, there's a lien against the property for $100,000 or whatever the number is. The bank will refinance that $100,000 loan into their new product. And during the course of the conversation, the investor says, well, it wasn't a traditional hard money. It was a hard money loan from a friend. And I said, well, what about the deed of trust? Well, they don't have one. I said, what do you mean? They have a promissory note, which the investor recorded. Okay? So that's not the way this is supposed to work, and I'm going to explain it over here. First off, what is a promissory note? Promissory note is an IOU. Okay? It is nothing more than an IOU when it contains a specific promise to pay rather than simply acknowledging that a debt exists. So the promissory note is the actual IOU between you and the lender. Okay? It's usually not recorded. It can be, but it usually is not. Okay. It's just an IOU. Okay? So in this point, this particular investor has an unsecured loan. Right? So a deed of trust or a mortgage, and that depends on which state you're in. So this was Colorado, where the call came in from, which is a deed of trust state. Okay, the deed of trusts are recorded. All right, they are recorded, and when you record it, it places a lien against the property. A lien position, by the way, refers to the priority of a lien which has been recorded onto the property. Lien position is by date of the recording and not the amount of the loan. So a lot of people don't understand that. I just want to get that out of the way. Okay. The deed of trust or the mortgage securitizes the promissory note. It's a pledge of the property as security or collateral for the loan. It securitizes the loan against the property and may or may not include the exact details of the promissory note. Okay? So here was the problem. They never made a deed of trust. So when they went to the banks and the bank would look it up, it looked like a cash purchase, which it was, because there was, in their eyes, no loan in place. So what they failed to do was create a deed of trust or a mortgage and record it. If they would have followed that simple task, they should have been fine. Okay. Along those same things, banks have seasoning requirements. So and this is the problem the investors having, saying, listen, they won't do a refi for 12 months, and that's because it's considered a cash-back refi, which banks are not really too keen on doing. Although it's coming back a bit, it's not their flavor of choice per se. Okay, so seasoning requirements. Seasoning requirements, they're all over the map. Every bank has their own, but here's some of the main ones. Okay, they have seasoning requirements when it comes to a cash purchase of a property. They have seasoning requirements, and when I mean seasoning, means certain things have to happen before they'll extend a new loan. So time of ownership. If you have an LLC, they may have a new rule. If you're owned under a corporation or a partnership, maybe these things all have rules, say 6 months, 12 months before they can do something. If it's in your personal name, maybe it's a heck of a lot shorter. So I owned it in an LLC, and I realized the bank says I won't refinance you in an LLC. It has to be in your name. So then I move it from the LLC to my name, and the bank says, yeah, we'll do it, but it's another 6 months. Well, why is that? Because you've only owned it for one day. The LLC owned it before then. So now I have another 6 month period again, or another 12 months. So it's an issue that you have to be aware of. Sometimes banks will say, listen, yeah, we'll refinance you, but it has to be rented for 6 months. Well, that would be nice to know up front. We don't refinance banks within 6 months after it's been listed on the MLS. Well, again, that would have been nice to know. Okay, so here's what you want to do. This is before you go do your deal. In my opinion, ask before you purchase. Ask these questions to your lenders. Give them an example scenario. The property address is 123 Main Street. The purchase price is $100,000. The repair cost is going to be $10,000. The estimated ARV is $140,000. My total cost will be $110,000, and I'm hoping to recoup 100% of my cost. Is that possible? Okay, we found this is the best way to talk to a bank. Just give them a scenario so they can answer the questions. It doesn't care if it's real or not, but they're not very good at talking with make-believe. So you have to give them something. So this is just make something up. It doesn't matter. Okay, if you don't know how to make something up, go find a wholesaler's deal and pretend it's yours. Pretend you're going to buy it, and then ask the scenarios. Ask them things like, what loan package do you have that can help me with this scenario? How much are the closing costs, and can they be rolled into the amount of the loan? What's the rate and term of the loan? What are the qualifying guidelines for this loan or program? In other words, do I have to be over the age of 15? Have to be less than 50? Do I have to have such income? Do I have to, do other things? Okay. What documents do I need to provide? How long will the entire process take? This is kind of important, especially if you're sitting on hard money, and hard money is maybe 3 months or 6 months due date, okay, which is also expensive. Is there flexibility with how I hold title to the property? Okay, if you find somebody that says you can hold it in a trust but not an LLC, and you want to borrow in the name of a trust, then you can. But if they say you can't hold it in an LLC or a trust, but yet you bought it in an LLC, you have to understand what you can and cannot do. Okay, what are all your season requirements with this loan? Okay, title in the name of an LLC, the name of a trust, previously on MLS, purchased property less than 60 days ago, property purchased with cash. My point here is you need to understand what it is you're trying to do before you go into the deal. The bigger issue for this particular one was there was no deed of trust filed in this particular case. And so what that investor is going to do, they're going to create a deed of trust and march down there and file it immediately, and then go talk to the banks, new banks, all over again. I hope that helps, but understand clearing up a deed of trust is what drives banks to allow the refinancing. It's looking for liens. They won't do a refi on a cashback. I know there's some, but generally speaking, it's a tougher way to go without a lien. So even if you're using your own cash, you might want to consider maybe creating an LLC, putting cash into the LLC, loaning the money back to yourself so there's a lien against the property. There's lots of creative ways to do this. Anyway, I hope that helped. That's all I got for today. And if you got any questions, check me out on Tuesdays. We got an open wire for about 3 hours, and we'll answer anything you've got and see if we can't help out. Okay? Thanks. Andy Bacon with the Bacon Group. Cheers.